week ending 8th August 2025, the RBI held its repo rate steady at 5.5%, a move aimed at balancing inflation control with economic growth. With inflation easing but global risks like tariffs still on the horizon, the central bank chose a neutral stance, prompting a cautious reaction from the investors. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. The Sensex closed around 79,858 points, while Nifty closed at 24,363 points, marking a 6-week of losing streak, the longest since 2020. Markets turned negative across the board. IT and pharma led the losses, with 15 out of 16 sectors ending in the red. Global headwinds, including 50% US tariffs on exports, combined with continued foreign investor outflows, kept the sentiment cautious to negative. While we wait for July's mutual fund data to be published, let's dive straight into Strategy of the Week. This week, let's decode a simple yet powerful approach, laddering your investments. Let's start with a quick question. If you wanted to take a holiday, would you sell your long-term investments to pay for it? Well, most people wouldn't want to. But how? By utilizing laddering, which is spreading your investments across various time horizons so that money is ready when you need it. Money needed in 1, 3 or 5 years is invested separately so that you never have to touch long-term equities to meet your short-term needs. Let's decode this with a personal library analogy. Magazines, quick reads, immediate use, just like short-term low-risk investments. Novels take few weeks to finish, just like medium-term funds for next 2 to 3 years. Encyclopedia that you keep for decades or lifetime, just like your long-term equity portfolio, quietly growing in the background. By keeping and arranging all three of them in order, you have the right book at the right time. If your investment portfolio was your personal library, would you have right books for every chapter of your life? Do let me know. Equity funds best suited for 5 years and above goals like children's education or retirement, where long-term wealth creation matters more than short-term volatility. Hybrid funds, a perfect blend of debt and equity, and for a time horizon of 3 to 5 years. Debt funds, perfect for 1 to 3 year goals, preserving capital or benefiting from declining interest rates. And once you have arranged your books by time horizon, the next step is to pick the right book when needed. Just like picking the right fund category to complement your time horizon. May I please ask, which shelf in your investment library needs most attention? Short-term, medium-term or long-term? If you inherited multiple FDs, what would you do? Would you simply roll them over or look out for other options? This was exactly the question Vaidehi faced in 2021 when her mother, Krishna, inherited several fixed deposits from her late husband or Vaidehi's dad. Krishna had been a housewife for her entire life and did not make any investment decision prior to this. Hence, with help of Vaidehi, we started asking what was truly important for Krishna. For Krishna, it was important to preserve the capital, earn better than fixed deposits, avoid investing in equity or shares, and keep the flexibility to be able to access funds if required. As we worked through her plan, we recognized an important element. Any guesses? Well done if you thought tax efficiency. Krishna, as sole inheritor, could benefit significantly from tax-effective strategies, something she did not consider prior. But through our discussions and informed decision-making, this became a key component of structuring her investments. But what was the problem with simply rolling over those FDs? In 2021, standard FD rates were about 5%. On the other hand, inflation was about 5 to 6% too. On top of it, with taxes, there was no real return. By rolling over FDs, Krishna was able to achieve her goal of preserving her capital but not of growing wealth. So, what did he do? As her term deposits matured, they were reallocated to debt funds, mainly short duration fund and corporate bond funds, which offered 7 to 8% annualized returns, better post-tax return due to indexation, liquidity without penalty or lock-ins, and professional diversification of high-quality bonds. And what is the outcome? In last 3 years, Krishna's portfolio has grown steadily. She has been able to preserve her capital and enjoys peace of mind and flexibility, all without equity exposure. This week's quote is another classic from Warren Buffett. Do not save what's left after spending, but spend what's left after saving. And the essence is, savings come first, lifestyle comes later. This is the foundation of every long-term investor's journey. Ouch! I hope my siblings aren't watching. They exactly know who I'm talking about. So, tell me, how do you prioritize savings in your monthly budget? Now that brings us to the wrap-up of Signal Episode 2. In next episode, we'll deep dive into MFI's mutual fund data of July 2025 and what it means for investors. We are building a strong community of calm, consistent and confident investors. If you're one of them, why not like and subscribe us and tell us in comment, how do you remain disciplined in noisy market?